Ladies and gentlemen, it's a pleasure and honor for me to welcome all of you to our online seminar focused on Indian bond market. My name is Cbonds. I'm founder and CEO of Cbonds. First, I will probably make a brief introduction to what is Cbonds and why we are doing this event. Cbonds is a data provider on financial markets. We provide data mainly for bond markets, but also we recently started to cover other instruments as well. Our head office is located in St. Petersburg, Russia, but in terms of data coverage, in terms of client base, we have already become a global company, so we provide data all over the world, and we have clients from nearly all countries in the world as well. And very recently, we have finished a long-lasting and very challenging project, which was a coverage of domestic bond market in India. Like about 1 month ago, we completed it. And it was very challenging first because of a number of bonds outstanding in India. I mean, government bonds, bonds of states, corporate bonds. So now we have about 19,000 bonds outstanding, which means that in this regard, India is the second largest market in the world after United States, not in the volume, but in the number of bonds outstanding. But even more difficult was that data on Indian bonds are quite fragmented. So you need a piece of data is here, a piece of data is there. So you need to do a lot of data collection, verification, double checks, etc., etc. So it was really a huge job, and I'm proud that we are finished with that. And now probably we have the best database on domestic bonds in India, with more bonds in our database, more accurate data, more in-depth data than other data providers, probably. So, of course, the seminar is our step to share this with the world. So we want people who are connected to bond market in India, both within India and outside India, to start using our data, to work with us, to provide us feedback, which will help us to make our product, make our coverage, our functionality even better than today. A brief outline of today's agenda. First, we will have a presentation from a brilliant expert, Rohan Maheshwari from Dubai, followed by two presentations from my colleagues, Anita, who is head of our emerging market local coverage team, and Shri Vijay, who is our client manager for India and Asian countries. Very good news about making such events online is that they are very interactive. So I would appreciate you to ask questions. There is a chat on your right hand, so you can easily type your questions to our speakers, and we will do our best to answer all of your questions. Well, so now I'm proud to pass the floor to our expert, Rohan Maheshwari, who is investment strategist. Rohan has master's degree in economics and also has CFA and CIMA certificate. He is a seasoned private banker with more than 15 years experience across the globe. And now Rohan manages a portfolio of ultra high net worth individuals, including even royal families in United Arab Emirates, with total assets under management more than 200 million in USD equivalent. So, Rohan, the floor is yours. Thank you very much.
Hi, good morning. Am I audible and clear?
Yes, absolutely.
Hi, good morning. Am I audible and clear?
Yes, yes.
Great, great. Just give me less than 10 seconds, please, so that I can just conclude the... Oh, wow, yeah. So we start. Welcome all. I believe, thank you so much for having me here. And before we commence, I would like to thank the entire team of Cbonds. and all the respected participants for having me here. I sincerely hope that each one of us and our loved ones are safe and keeping well during this unprecedented and stressful times. So, as you correctly said, let's begin with the global economy. So I would like to rephrase it into three key points. One is what is happening in the global economy, what do we see in coming 3 months and 12 months, and how to structure our debt portfolio. So let's begin with global economy, and let's recap it for a couple of minutes. And in case if there is any questions, we can take it in the last. So the International Monetary Fund is now forecasting the biggest global recession since the Great Depression of the very distinct 1930s. Yet, after equity and bond market tumbling since the end of the first quarter of 2020, it is more than 20% down than the high point. Now, many investors across the globe, they keep on asking me that, is this the start of the new bull market? Or perhaps global market is defining the gravity and we are just heading to so-called bear market rally. Equities are there, of course, to climb the wall of fear, and last week was again an example of such bravery. Global stocks were down, spread in quality fixed income widened, and we all experienced US oil prices dipped to an incredible, mind-boggling minus $40 a barrel. I mean, who would have imagined that, isn't it? A new US unemployment claim hit almost 4.5 million in just a month. Then again, equity investors don't care too much about what's going on now because they always try to define the future. And I would like to say they are notoriously more optimistic than the other investors because they see the opportunity. And what is their bet? Their bet is that authorities will be able to gradually reopen the economic activity throughout the summer. And the second bet is they will be able to channel so-called helicopter money to household, small and medium enterprises, we call it SME, so that the first don't go broke and the second don't go bankrupt. In my last broadcast, which I did with some other company on April the 13th, I had concluded global equity market will rise in an anticipation of the possibility of global recovery. And this has now happened. But at the same time, major economies remain frozen under stringent lockdown measures. Most importantly, treasury yields remain under pressure, especially yields on maturity below 5 years. Now, when I talk about yields on maturity below 5 years, I'm talking about investment grade bonds or so-called IG bonds. The futures market are even flirting with the idea that by end of this year, the Federal Reserve might have introduced negative policy rates and will join hands with various organizations like European Central Bank, Bank of Japan, SNB, Swiss National Bank, because they all are in negative territory. In reality, not only the bond markets are unconvinced for the growth because they have discounted the equity markets themselves remain muted and unconvinced. In fact, once financial markets start seeing the prospect of economic recovery, it is the undervalued often takes the lead. Stocks like banks, car makers, energy, material, to name the few. Instead, today, those companies have hardly improved their depressed values. Today, fixed income and equity markets are set for high quality papers and stocks respectively, so-called giants. Now, these are precisely the companies grow also with a relatively depressed global economy. Simply because so attractive is the market for movies, Netflix, deliverables, Amazon, and we all are so tech savvy, which is we use the devices from Apple, Microsoft, etc., etc. But here, this time, more important reflection over the last more than 10 years, the period of relatively slow global growth, these companies have been so successful that their share of overall US index has mushroomed, and while others have shrunk. That's why over the last 2 months, US equity market has recovered rapidly than other national indices. And US equity market being more than half of the global markets. And that's why global market has risen too. And hence, let's precise in interpreting financial market expectations. And hence, there will be a W-shaped recovery and not V-shape. I repeat myself, don't expect a V-shaped recovery. It will be a W-shaped recovery. And this is a reason why I'm neutral in equities and overweight on high quality growth stocks. Because on the horizon, on our near horizon, there is no significant growth story across all the countries and companies. What matters, therefore, is what you buy, the right growth story, limiting yourself with few sectors of the economy, not the whole bunch. Now, this was a recap of what is happening. Now, let's foresee the coming 3 months and the next 12 months. The cycle inside our head. And as correctly said, a lot could happen, but most of it won't actually happen. As I mentioned earlier, the bond market and equity market are expecting sluggish growth till year end, and I will not be surprised if this continues till the first quarter of 2021. But what now? I would distinguish between the next 3 months and the next 12 months. Over the next 3 months, market will not pay attention. I repeat myself, over the next 3 months, market will not pay attention to the economic numbers. Horrible they will be. Instead, they will extremely be nervous about the COVID-19 infection numbers. Will the gradual easing of lockdown measures succeed, or it will create a second wave of massive new infection? Now, if the second wave does materialize, I'm sure we should expect significant correction across the sectors, across the board. I hope investors are not having naked position in the market. And if infection numbers remains controlled, expect a full bull run, outperformance in the market. Stocks like banks, industries, energy stocks, etc., would rally. Credit spreads, particularly in high yield and emerging market, will tighten further. But what will happen beyond next 3 months? As we move into 12 months horizon, economic consideration will once again take a spotlight over health security issues. US unemployment rate will be narrowed down, and this will result in a strong growth. One thing which will change however, interest rate will reach a new and a lower corridor, and they will stay there for a long period. And this will be a very good news for those growth stocks and quality fixed income papers, corporate earnings, high beta stocks. Why? simply because the value over long-term earnings is intact due to lower interest rate. I mean, we all need to ask Donald Trump why he loves the low interest rates. This is absolutely the reason. But on the other hand, sluggish growth put some serious question mark behind the sustainability of the corporate earnings. Hence, as mentioned earlier, fixed income investors should majority hold high quality papers, and of course, depending on the risk appetite, horizon, one can lower down the quality as per their needs. Now I come to an interesting topic, building a debt portfolio, isn't it? Now, before we start, let's understand what's happening over the last 10 years. And as Warren Buffett used to say and says, when the tide goes out, you actually know who is swimming naked. Investing is simple, but not easy. Exactly what went wrong with retail fixed income investor since little more than a decade. Their greed, or I may say their lack of understanding, have made them invest in junk, and now they are in catch-22 situation. Most investors, bear with me for a second, please. Yes, thank you. Most investors are unaware of how to access the risk in debt. They are just unable to distinguish between interest rate versus credit spread, or so-called credit risk or duration. Give a lot more weightage to controlling the credit risk, especially if you are a risk averse investor. I repeat, give a lot more weightage to controlling the credit risk, especially if you are a risk averse investor. Don't overreach for yield or inch down the credit spectrum. Debt is not about return maximization. I prioritize return of capital over return on capital. I prioritize return of capital over return on capital because debt are capital preservation. To add alpha to one's portfolio and beat inflation, I prefer the more volatile asset class, which is equity. So, as mentioned few minutes back, when it comes to debt, there are two aspects one must never lose sight of: safety and liquidity. If you are ultra conservative, then debt must be ignored. Just bear with me for 30 seconds, please. Yeah. So if I repeat myself, if you're ultra conservative, then the debt funds must be ignored. Credit risk are completely avoidable over the short and medium term. I say this because it won't change portfolio returns dramatically on upside, but the risk taken will increase manifold. Debt funds are not substitute of fixed deposit. I say this because the prime aim of debt is capital preservation and stability to the overall portfolio. It acts like a cushion, and we all need cushion right now. It is supposed to make it easier to stomach the risk elsewhere in the portfolio. Now, what exactly investors have done over the last decade is trying to juice the returns by adding risky debt, which has sabotaged their portfolio, and hence investors holding such papers have seen negative returns similar or more than equity. It is very easy to get carried away by the advice which are doled out in the media, in the market, in various books. Hence, you need a professional tool and platform which gives you in-depth report on the issuer and the transparency. And I must say, Cbonds platform has both of the above. There is more than $1 trillion of debt which is issued at least a quarter, it is just impossible for any of the investors to rely the transparency, to rely on the random facts, what is happening. And Cbonds does that for you. Random transaction based investing will harm the investors and you will end up with a lot of junk. The platform of Cbond has a clear identification of rating the issuer. And I'm not saying the rating of the issuer by internal agencies, it is by S&P, Moody's, etc. To safeguard against that, never view any investment in an isolation, always view it in relation to your portfolio. And Cbonds does that for you very professionally, and you can pass it on to them, manage that data holistically. Now, once you adapt this step, then you will get investments that complement each other at the same time avoiding portfolio clutter and duplications. Finally, don't invest only because the past performance has been great. This is a mistake many retail investors, even fund managers, young fund managers have got trapped in. I deal and interact with various fund managers across the globe. Everybody is trapped in because they were not able to distinguish between the credit spread and the duration and the risk. It's an inherited risk. We all need to use a professional platform. I conclude. Once again, thank you for hearing me patiently and having me here. I hope everybody stays safe and blessed. Thank you so much for having me.
I thank very much, Rohan, for the brief information. We are now open to take any questions. I don't see any questions yet on the in the chat yet. So we'll wait for a couple of minutes. If you have any questions, please go ahead and write them down so that we discuss them with Rohan. So we have a question, Rohan. If you could just switch on your camera and microphone so that we go ahead and take few questions. A specific question is about Indian market, which is being asked, and is how do you see issue of liquidity itself in the Indian markets? I believe it is being asked about the near future.
Thank you so much. I think this is a very interesting question. And the investor who has asked this question, I hope he knows that liquidity is a big issue in Indian market right now. I mean, classic example, I was just going through an article and there was news everywhere. Franklin Templeton, one of the largest fund house, has closed their various debts. So coming to the crux, in debt market, I see a liquidity issue. And mark my words, I will not be surprised if various emerging markets, especially India, Brazil, South Africa, China, they start defaulting on their corporate debts. Dollar is rising. Various currencies are devaluing it. It is not going to be easy because banks are not giving working capital. So yes, there will be a liquidity issue. There will be a long-term issue. Now, what is the solution for that? Now, as I told very clearly in my presentation, look out for high quality papers. Don't go for creating alpha or maximizing your returns. And this is exactly the mistake what various fund managers have done. So yes, there will be a liquidity issue, but Indian government has done brilliant job. I think RBI as well as SEBI has done brilliant job to liquidate, and as well as I think they have allowed many fund managers to invest more than 20% in GSEC. This was a news which was over the last 24 hours. Do not compromise on the credit quality. I hope that answered very briefly and very crisp.
Yeah, thank you very much. So I'll check the chat, and if you have any specific questions. So there is one more user who is asking, are the papers below A safe? So this specifically talks about so A grade. So that is the most grade.
Sorry to interrupt. Go ahead, please.
Yeah, so that was the question. So I'd like to understand. I mean,
so I believe this question has come from India.
India, yes.
Okay, so I would like to just rephrase it. Now, when I'm sure the investor is asking me Indian rated government agencies or Indian rating which is A plus or maybe A. Now, let me just repeat myself. Global agencies, they do not rate Indian corporates which are denominated in INR. So I believe the question is that what happens with the Indian corporates who have issued papers in India in INR and they are rating agencies from CRISIL, etc. Yes, I don't think anything below anything in the range between triple A plus till double A plus should be the horizon for an investor. Strict no for anything, especially in INR. Strict no for anything below double A plus because it comes. Triple A minus double A plus because it comes with a huge risk. And you have seen, I mean, what is the reason why Templeton has closed down their debt funds? It is this classic example. So definitely not corporate debts. Now, I would just like to rephrase it in a larger horizon. When you talk about dollar denominated bonds, as Vijay, you know that your company does brilliantly well to capture the international bond markets. I think the range would be, and I personally feel the range should be in from double A plus, triple A plus, or triple A minus till triple B plus. I would actually not concentrate. I'm talking about international, which is a dollar denominated. I would concentrate more on a duration and inflation rather than a credit risk. So if, for example, if you have $100, I would keep at least $70 in a maturity less than 5 years, whether it's India, whether it's anywhere. So I hope that answered the question.
Right. Yeah. So I'll check one more question so that we go ahead. And the question is, let me check. So another question is about the regulatory environment on debt. Again, it is from India. I wanted to understand that they want the attendee is asking. There is too much of confusion where banks trade on different platform and retailers are left to deal on an entire different platform. So the thing is, I mean. I believe Cbonds can solve this issue because you will get an.
I was just about to say that question is not for me. That question is for your team.
Yeah. So because we have a place wherein you get information from different sources, so I'll be showing that during my presentation. So I just wanted to answer that question myself, and. So the last question which we can take is which type of debt investments can be considered as most secured? I believe we are talking about global as well as Indian market. So it is a general question.
Yeah, I think it's a very good question, especially for fixed income investors. I feel can you repeat the question once again, please, Vijay?
So what is the most secure debt investment in the global or Indian market? Like both they are talking about. So which bonds are specifically considered as most secured?
When about global market, and because it's just hanging here. Am I audible, Vijay?
No, there is some issue.
Am I audible?
Your voice is breaking, actually.
Am I audible now?
Yes.
So
I can hear
yeah,
you
so just to I would like to give a little bit detailed background on this. This is a very interesting question where people and investors have got stuck. We need to realize an investor needs to have a clear risk appetite to go for debt investments. Now, if anyone is giving anything above US Treasury or maybe government GSEC in India, we need to realize that what is the reason why corporates are giving 8.5 to 9%. Now, just to tell you, this is a news which is there. There is a state in India, Uttar Pradesh. They came out which are 100% guaranteed, which is giving 11% in INR. Now, whether that appetite is there to take 11%, where the largest bank of India, ICICI Bank, HDFC, State Bank of India, is not giving more than 6.5% or maybe little more than a quarter on the fixed deposit, then why a state government is giving? Now, that is a question which needs to be answered. Now, yes, you should not go for anything which is giving maybe 100 bips over the treasury of the respective country. So, in global market, I would concentrate more on an IG bonds rather than a junk rating bonds, because junk ratings are going to default. Mark my words, Vijay. These investors are going to come back to you after 1.5 years asking, oh God, what we have done. We have got into junk. Because last 10 years, everybody has juiced the returns in the corporate debts. And it's not going to be easy, because somewhere debt needs to restructure. I mean, let's take a classic example of Gulf. I mean, who would have imagined minus $40 a barrel? It is mind-boggling. And Saudi Arabia, which is like father of Gulf nation, has come out with VAT of they have tripled from 5% to 15%. Now that clearly means that the corporate earnings, the countries are running out of the liquidity. Why would an investor go for anything below IG bonds? Definitely not. I mean, if you ask me personally, in my career of last 15 years, I have never ever done below anything IG bonds. I hope that answered the question.
Yes, it did. So thank you very much. One last question.
Thank you so much for having me.
Yeah. So last question.
Go ahead, please. Okay, I'll take it. Last question.
Trustworthiness of the rating agencies. So, because the question is asked, as many A rating bonds have been downgraded directly to D after default. So, I mean, want to understand how trustworthy are the rating agencies, and how do we analyze that?
I think this is a very good question, which has come. How do we trust rating agencies? Now, let me move that, okay, and let me be more very clear. Do we have an option? Does retail investor have an option? Does Cbonds have an option to rate? We are dependent on the rating agencies. Now, the question is how important and how trustworthy they are. I think it's a debatable discussion. Obviously, they are, because you don't have government agencies, example, Norway, European, US, to that matter, India, denominated in various dollar bonds. They are totally taking money, raising money. Rather, I would not use the word taking money, raising money from the international market, depending on the rating agencies. So obviously, they are trustworthy. The debate can happen that once the bond defaults, they downgrade it. But we need to realize they are also human beings. Nobody expected Lehman Brothers to collapse in 24 hours. So yes, so that is one of the things. And second important thing is, I believe rating agency in today's unprecedented and difficult and stressful times, they also need to realize that it's not going to be easy for raising funds from the international market. So I don't think right now this is a moment where rating agency will downgrade anything. That is the only reason why I keep on saying and accentuating on the point, don't go for below anything triple B plus. I would rather say actually concentrate more on 70 to 80% of the portfolio, concentrate more on A plus. Obviously A plus will not give you yield, but at least it is giving you cushion. At least you will have
Right.
at least you will not have a sleepless nights. So yes, rating agencies are trustworthy. It might be debatable, but I think we need to trust them. They are doing brilliant job. Thank you.
Okay. Thank you very much, Rohan. So
Thank you,
it was
Vijay. Thank
very
you for
informative.
everybody. Stay safe and stay safe and stay blessed. Thank you.
Thank you. Now I request Anita, who is the head of the local emerging market, to take the floor and give us a brief overview of the coverage of our database. Thank you.
Hello, everyone. I hope everyone is safe. And for now, I would like to describe you in a snapshot Indian debt market. So in a nutshell, Indian debt market is pretty advanced in terms of infrastructure, mainly is wholesale, with the majority of institutional investors, and the majority of instruments are top-rated. If you see the next slide, on the primary issuances, there could be noticed a volume growth, and in the same time, the number decline in issues. So we consequently could conclusion that the average issue amount increased during the last 2 years. On the next slide, you can see the Indian government map, which you can find on our website. So it's directly proportional graph that reflects the relation between yield and duration. So the more is the duration, the more yield you can find. So it's according to your risk profile, you can find the bond which you are interested in. So let's
Anita, sorry for interrupting you. Please switch on your camera. Thank you.
So let's turn to the Indian world market yields. So as you can see, over the period of slightly less than 2 years, there is a decline in all sectors. So I mean corporate bonds, 10-year GSEC, and commercial papers. You can see that there was an increase in March, and it could be easily explained by concerns over the debt serviceabilities by companies. So let's go to the next one. It's the same, but we have here we can see the graphs of AAA instruments presented by non-banking financial institution, housing financial institution, and all Indian financial institution. As you can see, this here is the same trend, so it's a decline over the period of year. However, there is a increase in March, which explained by the same reason as mentioned previously. On the next slide, you can see the latest monthly result in the corporate bond sector. As you can see, the volume, as I mentioned previously, increased by 16% to 79 crore rupees from March to April. And regarding the sectoral presentation, you can see that the majority of the issuers were presented as diversified, so with no specific industry. The second place was taken by banks and term lending sector, and the third is power generation supply. So regarding weighted average yield is decreased by 104 points to 6.98% in April. And as I mentioned previously, again, the majority of bonds were issued in a rating category of AA, minus, and above. So let's turn to our coverage in Cbonds. We have a pretty advanced database, I suppose in the best in the world in terms of local debt market in India. So currently we present issues, more than 18,000 corporate and municipal issues. If you go deeply, the majority of them are issued with a fixed coupon rate. We also have a pretty developed database on the government bonds. It's more than 900 ones. And as well, we provide data on international bonds, as Rohan mentioned. If we go deeply, we also have issue documentation that is all publicly available. And moreover, if we go deeply on the characteristic of the market, the average term of maturity of government bonds is 12.5, and concerning corporate issues, it's 7.7. And as well, we provide data on perpetual bonds. So right now, we have more than 200 bonds in our database with a perpetual maturity. As well, we provide data on all credit rating agencies, local and both international one like Moody's, S&P, and Fitch. Concerning quotations, we provide indicative prices and estimated prices for government bonds, state development laws, and as well corporate issues by FIMDA, Financial Benchmarks, Clearing Corporation of India, and as well mutual fund is Canara Beko, and market participants, for example, Invest Brokerage, Trust Capital Services. And as well, on our website, you can find quotations in terms of different segments from BSE and National Stock Exchange of India. So you can find different quotations in sectors as retail trading segment, wholesale debt markets, and total, and even the latest update on request for quotation trade segment. So it's all for now, and thank you for listening. I yield the floor to Sri Vijay, who is going to show you our database in reality. So thank you.
Thank you very much, Anita, for the brief overview of our database coverage and information. Now I would like to take you through the platform. I will share my screen with you now. Just a second, give me a second, let's share. Just a second, I'll share it. Okay, so now here is the website. So as you see, we have a new interface which is very user friendly, and this is a newly developed platform. It is very fast and it works really well. We have because we have traffic from 80 different countries, so we decided to develop a platform which will be convenient to use, user friendly, and has more functions as per the latest technology which is available. So we have different types of functionalities to get data from the platform. So we have mobile app, Excel add-in, then API and data feed. So API and data feed is something we send data packages to the banks or financial institutions which use them for their internal use. And today we'll be talking about our web interface. So it is a premium website, as you can see. So I would like to go ahead with and start with our heart of the platform, that is our bond search tool. We have a quick search as well. So let's say you want to we want to know information on a specific bond. We have an ISIN or name of the bond, say Adani Ports. So you just type Adani Ports, and you will see that information on this particular bond will pop down. So you can see that both in USD and INR or any other currency bonds which are there of this particular issuer or stocks, you can see them here. You can even further specify, like you want to know only the USD bond. So you can put USD there, and you will see the results here. As you can see, only the USD bonds of this particular issuer are displayed here. You can click on the specific bond, and it will take you to the bond page here, where you have descriptive information like the core parameters, then trading chart and everything. I'll go through this information in details, but I just wanted to show you the two different methods of retrieving the data for using the tool. So another most important tool is the bond search. So it is a multi-parameter tool. So you can, as per the user's requirement, you can put in the criteria or parameters. What we can say, we have more than 100 different criteria. You can put them here, and you can get the information on the bond. So let's go ahead, and what we can do is, suppose let's take example as India. And suppose you want to know Indian in INR and bonds with yield, say from 4 to 8. So once you click on search, it will give you retrieve. So we right now have coverage of more than 350,000 bonds, and we are proud, as our CEO said. We have more than 18,000 outstanding bonds of Indian market. So we believe that there is no such source of information or data provider who has such vast coverage of bonds. Now, as you can see, these are the search results based on Indian outstanding INR bonds with yield from 4 to 8. So we generally recommend to export it to Excel. So we have an option, because right now we have 116 bonds, but in some queries we have like 1,000 bonds or more than that, and it is convenient to work in Excel. So we have embedded a functionality to download this data to Excel and work with it. Then you here in the results, you have a table with all the information, core data. Then you can see the rating, yield, prices, indicative price, then Cbonds estimation. So Cbonds estimation is our own methodology. So we calculate prices or yields based on the information which we receive from different market participants. So we have, so that information documentation is also available. Then you can also see this in a graphical interface by clicking here. So we will have a yield to duration chart, wherein you can see all the bonds of this particular search result. You can, what we can do is we can segregate them by issuer. So you will have all the issuers here and bonds in different colors mentioned here, shown on the graph. If you want to eliminate some specific issuer, so if you don't want suppose L&T Finance to be shown on this platform, you can click on this and it will disappear from the chart. Now, I don't think we need to check it by currency. The thing is, because we have already selected INR bonds, so these are all INR bonds, so there is no need to segregate them by currency. Now, let's go to a specific bond so that I show you the bond page. But before that, I would like to show you something, that is, we can save this specific query so that every time you don't have to put all the criteria. So if suppose you have specific requirements and you search based on a criteria, you can just click on save query. I'll just put suppose India, for me to understand in future 4 to 8. So I'll understand that these are outstanding query. This is a query for Indian bonds with yield 4 to 8%. I'll save this. So now let's go and search again for these particular bonds. We again go to bond search, and you will see an option here, saved search queries. You click on that and you can see that this new I have some different queries also saved, because Rohan also mentioned that you need to focus on some investment grade bonds and don't chase for the yield. So I have selected some Indian bonds as well with yield. So once you click on this, you will see again the same result. So you don't have to put again and again the same criteria. Now let's go to the bond page. Let's talk about any examples, say HDFC bond with coupon 8.58%. So this is the bond. So once you open the bond, you will see all the core data. Now we have ratings from different rating agencies for the issuer as well as for this particular issue. Then we have core data, that is outstanding amount, the date of the placement, what is the maturity date. You can see all this information here. We have largest database of prospectuses and documentation, so you can download it. We have this function available for all the different plans, subscription plans we have, but you can just click on this and it will download the prospectus and you can go through it. Another important part is trading chart. So you see here how the performance of this particular bond, like price, yield. So if you click on map, it will show you the different issues of this particular issuer, that is yield to duration. You can similarly eliminate some of the points here, or some of the bonds which you don't want to be there on the table. For Indian specific market, this is a very important thing what we have done. So we have prices for different segments. I believe there is no other such platform which has this in place. So we have prices for segments, like on Bombay Stock Exchange, you have prices for retail investors as well as for some corporate investors, like some mutual funds or other corporate investors. So we have that segregation in place here, not from stock exchanges, but also from market participants like FIMDA Association and NSE also. So this is a very important part. I specifically made focus on this because this is something which is very important criteria, and not all the platforms have this. Once we go ahead, you can see that we have quotes from different market participants and stock exchanges. Then basic issue information again. What is the nominal amount, then coupon rate and all this information, cash flow, that is previous coupon payment or future coupon payments, we have it here, or all this information, what is the redemption term. Then we have again ratings. So this is in-depth rating from different rating agencies with the date of rating and everything of the issue as well as issuer. Another thing is bond classification. So we classify all the bonds, like some people in Middle East and all invest only in sukuks. We have senior secured, which is very regularly asked by the users. So we have all the classification in place. You can also search using bond search using these classifications. Now that we have understood how to search a specific bond, how to get an information, this is an aggressive part which we have covered. Now suppose you want to track a specific bond or calculate some information. So let's say you want to calculate what would be the yield for this particular bond if price of this bond is say 97% of the face value. You just use the calculator tool, put the percentage of face value, click on calculate, and it will calculate yield to maturity, what is the current yield, and all this information, accredited interest, and there are many parameters which it will calculate. So this is very important, because if you have a price which is being quoted by your bank or some other institution, brokers, so you yourself can calculate what would be the yield and other information. So now, how to track this particular bond or any other bonds which you are interested in or which you are in your we have in your portfolio? You just need to click add to watch list, select a trading floor. Let's select PRIMDA and save. So this bond has been added to the watch list. So let's go to the watch list tool. You click on a watch list. I already have some other bonds also added to the watch list. Now this is how the watch list tool looks. We have two different type of notifications, so you can set up notifications to keep track of bonds and take some decisions so that you are always informed if for some changes or anything. So one type of notification is a general notification wherein you can click on this. It will show you your previous notifications for 30 days, last 30 days, as well as you can make changes. So if you want to know coupon payment, or if you want to know news about some issuers which are there in your watch list, you can check this different items we have. You can save them, and whenever there is a change in rating or based on this criteria, you will receive a mail notification, as well as you will see those notifications here so that you don't miss. If you missed your mail, you can just log in and check these notifications here. Now if you want to track a specific bond, let's say the bond which we added, HDFC, so you just scroll right, you have information here. Same information is reflected on your mobile app as well. You just scroll on the right hand side and you see a bell icon here. You click on that. Let's say you want to know when indicative price of this particular bond goes below 97 and you purchase it. You want to purchase it, or you want to sell it, or if you want to just track the yield and everything. So you just save it. So whenever there is a change in there is a change in the price and it goes below the parameter which you have set up or value you just set up, you will receive a notification in mail. So this really helps. This is mostly used by lots of our clients who are there, institutional as well as private investors, which helps really keep track of the bonds and take proper decisions on time. So now we have gone through the information on bonds and everything. We also have different indices. So this is the same as bond search tool for indices. So we go to index search, and now let's say you want, so these also has same parameters. You want to know CDS credit swap of suppose India for last 5 years. So you just can type so you just type CDS India and suppose 5 years. Click on this and it will take you to the CDS page, and you will see all the information which is required. So So we have many indices, including we have now information on coronavirus for different countries and everything. We have that in place. So this is about indices. We are, of course, we are very strong in bonds, but we decided to, because we have lots of users and it is convenient to have everything in one place. So what we decided is we decided to add stocks as well on our platform. So you just go to stock search page. Similarly, you can type it here as well in quick search, or you want to know, you can type here. So let's say I type State Bank of India, and you click on that. So it will take you to the stock page of this particular. So it is very convenient to have everything. So we have traded volumes and everything, all the information on stocks also. Right now we have 40 different stock exchanges, information on 40 different stock exchanges, but we are now adding it. So right now, fairly, we have about 50,000 stocks in play, I mean, in the database. So let's, I'll again open a bond so that I show you information on it. So let's take a bond. This is the Adani Port. This is the Euro bond in USD. So once you scroll down, you will see that we have quotes from different market participants and stock exchanges. So if you see Frankfurt stock exchanges, we have intraday quotes as well. So it is just now updated when our seminar started. So we have intraday quotes as well as yesterday's closing dates. So which is very, very important for an investor to have everything in one place, get a benchmark information to take some decision. So Cbonds covers all the information which is required for an investor, banker. We have different solutions for each user depending upon the requirement. So I will definitely get in touch with every attendee, participant of this seminar to discuss like trial access or come up with some solution. Thank you very much. Thank you very much for attending. Thank you, Rohan, for your brief overview and investment ideas.
Thank you.
So you have my contact details. I'll send you all the information as well in a mail. You will have presentations also, and stay safe. Thank you very much.